Hi, thanks for tuning in to our Practical Nerds weekly podcast. I'm Shub, and together with my partner and co host Patrick, we normally invest in founders in design, construction, renovation, and logistics technology. Many of our friends in the ecosystem wanted us to start a podcast on the built world, and in return, we decided to honor their request with a show about nothing at all. Patrick, I was about to say that intro never gets old. Then I thought, hey, it shouldn't get old because it's quite new. So why would it get old just yet?
Yeah, I mean that would be quite sad, no? If things became old after 2 weeks. So luckily they don't. Yeah.
You mean
But
like the news?
also true, yeah. Also true. It's a very quick world that we're now living in.
Yes.
For sure. But I think listeners might not appreciate this, but I really want to share that about you. You are known within Fundamental whenever there's music playing as the person to always rush to the dance floor at the middle of the room and do a break dance. So just in case people didn't know that, you're the big break dancer here.
I guess that's as high quality information as the latest news cycle. So there you go.
So now someone really needs to meet you at an event and challenge you.
Best of luck to all those people who think that'll be a fulfilling exercise.
And getting you at an event in the first place.
Exactly.
Nice. So what's on the docket?
So, even though I think we're being goofballs with this introduction, I think you set us up for the topic of this episode quite nicely, Patrick, when we had this chat about it a short while ago. And I think I feel like it's one of those topics where we throw around jargon and terms all the time, especially as VC startups and popular narrative.
We're really good at that.
And yet, the gravitas of what you described, I think it's so profound. Even though I'm not sure where we will end up discussing this, I think just the profoundness of that observation is well worth sharing with our audience.
So you and I have been thinking about, I want to say maybe a year before we went into formating, capital formation for Fund 3. Basically, the question of, okay, what makes Decacorns? Decacorns are these companies that get valued at 10 billion or more. By the way, I didn't hear the following term a lot. Did you know there's hectocorns?
Okay, would those be 100 billion or more?
Yeah, exactly.
I hadn't heard of that at all.
Yeah, exactly. Maybe I just made it up. But so thinking about that, and then why would a vertical sector, any vertical sector, actually produce them over horizontal companies? So you and we have had these discussions, and they are very, very, very contrarian, actually, to the point where I think it challenges some of the fundamental assumptions of the venture capital asset class in the first place. But recently, we've been asked by a good friend and his friends, hey, can you explain to us how you are thinking about that? And, we're trying to get smart in this space, and it seems like there's momentum broiling for AC and construction tech and project-based industries. We want to wrap our head around how you convince yourself that is a good strategy to yield decacorns. And so that's what we're going to talk about. We're going really into some uncomfortable territory by talking about this because at least for me, Shub, I don't know about you, but at least for me, the reason why I haven't done that so far is because it's really contrarian and might really violate a few people's worldviews within venture capital. But still, let's do it.
Yeah.
Cool. So I want to kick off with a few statistics that you and I researched. This is going to be role play because Shub knows the answers. But anyway, we're gonna roll with it. So Shub, I researched a while ago the number of companies that make up, and by companies I mean the total universe of businesses, not just venture. Because why would venture be the only legit kind of companies? And in the numbers, you will see the answer is, well, they are not. So all companies I researched, what are the most extreme outliers of these companies, and what is the cutoff threshold, which is arbitrary, but where can you place a cutoff threshold?
Yeah.
And I applied a Six Sigma methodology to it. Six Sigma was invented by Motorola engineers in the 80s in a completely different context. So that one is about identifying six standard deviations from the mean. If you have less defects than that, then you are in a great operating business. If you have more defects than the Six Sigma, than the six standard deviations, then you are not operating well. But you can apply the same kind of statistical logic to the universe of all businesses. Okay, so we have between 330 to 350 million registered companies in the world. Between 330 million and 350 million registered companies in the world. If you now apply six standard deviations from the mean of that population, you're getting to, again, this is arbitrary, but it comes from the Six Sigma logic. You're getting to a arbitrary cutoff threshold of what people could consider the most extreme outliers, the most, exceptional kind of companies. And we're using market cap or private market valuation as the cutoff point. So first question here, Shub. Where would you guess six standard deviations from the mean on 330 to 350 million total population? How many numbers would fall outside of that and make them off-spec and exceptional?
In terms of market cap?
Yes. So before you tell me the market cap, just tell me how many companies you think there are that are falling off-spec.
Okay, so I think I remember the answer from earlier, but I'll give you the answer I had originally guessed, which was in the ballpark, but not exactly correct. So I had guessed 2000 when we spoke.
Yeah, it's a very, very good guess, but actually it's almost only half of that. It's 1,130 companies that with a Six Sigma definition would fall off-spec. So in Six Sigma, you would call them the defects.
Yes.
Here, the defect is what we want. It's the most exceptional companies. Okay, so now the next question that we asked ourselves is, okay, what is actually the cutoff, the threshold market cap? What you actually, when you first guessed this to me, after I had done like the analysis, I asked you blah, 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 you were on point. So you can just basically role play that again.
Was I on point, or did I get a slightly higher number?
Maybe you had a slightly higher number, but you were pretty much in the ballpark.
Okay, so I think I had guessed something in the 15 to 20 billion range, whereas I think the actual number is around 10 billion.
10 to 15, exactly. Okay. That's the cutoff threshold. If you're 10 to 15 billion valued, you're exactly starting to be in the 1130 off-spec exceptional companies in the world. And I want to call out again, not just venture. That's all the kinds of companies that are out there. Okay, that includes Microsoft, and traditional companies like Coca-Cola would be in there, but Palantir would be in there, Databricks would be in there, Klarna would be in there, Chime used to be in there, and now not after the IPO. They're just falling short of it, but I'm sure they'll get back in there. So all of the universe. So now I need to actually pull it back up. So that's interesting, right? So let's maybe pause here for a minute, but just for a moment of reflection, Shub. Sorry. Before we do the reflection, one more thing. And Shub, how many decacorns? So private. Let's leave out the private. Let's also include the public. Let's say recent startups, tech companies that are valued in the 10 billion plus range. How many are there in the world?
They're still private as of now.
Now let's include the public ones. That's fine.
I think you had shared this number with me, so I'll just recall from memory. Was it 50?
Yeah, it's depending on which month you look, it's between 50 to 70.
Okay.
50 to 70.
Okay.
But either way, I mean, you're very good at head math. So out of those 1130, how many traditional companies are then off-spec?
So that's between 1060 and 1080, which is anywhere from 93.5 to 95.5%.
Isn't that crazy? We totally obsess over decacorns in the venture definition, and we forget that there is 95% of the companies in that off-spec range that would never have seen a venture investor recently.
Yeah.
I mean, why?
I mean, that's a very fascinating question to ask, and but perhaps that's probably where we're going with this. So I'll not steal your thunder. Yeah.
Okay, so then I think this is just a I wouldn't call it a profound insight, but I think it's a thought-provoking insight. You know, when you think about all the companies that get fanfare, and you know, you're kind of, as a venture investor, you're slapping yourself on the back because deservedly so. You had the, I guess, courage, insight, taste, decision-making abilities, and so on and so forth, to spot an off-spec company within those 1130 when it wasn't obvious yet, or maybe it was obvious, but it was still very, very risky, right? So that's great. But actually, that's only 50 to 70 out of 1130.
Yeah.
Why do we never talk about the other 1060 and 1080 and how it would be desirable to actually be building those? Why? I don't understand, Shub. What is the reason?
I think so I think there's various fallacies and biases at play here. Perhaps the most obvious of those is it's deemed that they're dinosaurs or incumbents or boring businesses, quote unquote, right? And therefore they are the ones who will eventually get disrupted.
Yeah, because they can't tell a tech narrative, right? I think that's another reason.
And some of that is true. I acknowledge that. But I think the fascinating aspect of that is, hey, how much of the, call it the outliers, or let's say they were the index of the most valuable 1130 companies in the world, how much of that is untapped by, call it the venture activities of the last 15 years?
I mean, certainly our sector. Certainly.
That is right. Yeah.
Let's do a quick case study. Sorry, I didn't prepare you for this, but I know you know this case study very, very well, and you can speak to it. Visa and MasterCard. They would be in the 1130.
Yeah.
And within that, they would be in the 1060 to 1080. Not a tech company, not a recent venture, didn't receive venture funding, and yet among the most valuable companies, the most off-spec in the world. Shub, if you had to give like a short reasoning why that is, why?
By the way, the first thing I have to point out with that, you're right, they will not be thought of as tech companies. In my mind, I think they are definitely tech companies, but
Yeah?
I think so. I think so. But so okay, in the sense, technology is at the core of what they offer, and when they were created, they were cutting edge technologies for the time.
Decades ago.
Decades ago. That's right. Right. Yes. Will they be called technology companies today with the way technology is defined today? No, I probably not.
Yeah, and venture wouldn't call them
That is true. Yeah. Yeah, but are they fabulous businesses? Oh, absolutely. And again, for those of you who haven't, I really encourage you to look up the financials of especially Visa, but MasterCard is also very impressive. There are. It might be one of the top 5 businesses of all time in terms of how pristine the numbers look. It's really mind-boggling. It's something like 99% gross margin, and it's not a shenanigans type gross margin, if you know what I mean. It's legit 99+% gross margin, something like, I think 75-80% operating margin, and 57% net income margin after tax. It's
all the while.
Yeah.
So all the while, venture told us, no, but these 1060 to 1080 companies, they are not worth chasing and rebuilding, perhaps. Let's focus on WeWork.
Yes.
Let's find a business that fundamentally on a margin level and on a cash flow level doesn't make sense, and let's value it at 45 billion.
Yeah. Isn't that interesting?
Cool, I guess. Sure. So that's at least not your and my perspective. So let me continue the train of thought here.
Okay.
So Shub, then this is a lateral thought, but I promise we'll converge the two trains of thoughts. Okay, so when you now look at the venture world, And these 50 to 70 decacorns that currently exist, what do you think is the graduation rate for the companies that are today unicorns within venture, so valued at 1 billion, 2, 3, 4, 5, 6, 7, 8, 9? What do you think is the graduation rate to decacorn from being a unicorn?
So this, I was pleasantly surprised that I nailed it.
You were spot on when I asked you first time.
So the guess I had made was that only 3% of unicorns become decacorns, and lo and behold, you told me that was spot on.
It's spot on. It's 3.3 or 3.4%. Exactly. But presented in a different way.
Hang on. I think we need to weigh on what that means, especially for audience.
Please do.
Only 3% of unicorns become decacorns. That is a lower success rate in going from seed to Series A.
Yes.
Right? In fact, an order of magnitude lower, I should say.
50% is the graduation rate from seed to A.
Would you agree with me if I said that's a lower graduation rate from seed to Series B?
From seed to Series B, definitely. I think that would be around 25%, maybe.
Yeah. So just think about that. So a smaller proportion of unicorns become decacorns than seed-funded companies going to Series B.
Yet we obsess with unicorns when there is 1,000, and with decacorns, venture decacorns, when there is 1,060 to 1,080 companies that are more valuable than that wouldn't call themselves even venture. I find that a little bit arrogant, I have to say. I find that almost ignorant to the world. And people have asked us, hey, but aren't you just adverse selecting by looking for companies in your space? And we'll through this episode talk about why we think that's not the case, but I want to at least preface here, I think you are adverse selecting yourself by limiting yourself only to the possible universe of venture decacorns, the way venture decacorns in the past have been printed, because you're leaving out the other population, the other 95 that you could be backing.
Yeah. Oh, 100%. I mean, it also, by the way, begs the question, if seed, so you're right. Even when you talk of decacorn, it's kind of like, if any of you have seen the perspective of zooming out further and further and further, where you start from, for example, a grain of sand, then you zoom all the way up to a view of the Earth from outer space, and then you zoom out even further, you see the solar system, you see the Milky Way galaxy, and so on.
Good exercise.
It gives you a good perspective of where you actually belong. But isn't that so?
By the way, that's a technique that Brad Jacobs advocates for.
Brad Jacobs of QXO?
QXO, United Rentals, etc. He writes about that in his book. Yeah,
I was not aware. Interesting. I should read up on that. But isn't that interesting, Patrick? That only 3% of unicorns go on to become decacorns. Why do you think that's the case?
Actually, before I answer why, I want to give you an alternative perspective to that.
Okay.
Just this perspective, when I thought about it along those lines, it blew my mind. So what that means is that every additional billion that you add to your value, every additional billion that you add to your valuation decreases your graduation chances by 30%. So it's nuts if you put it that way, right?
Yeah.
So I'm a unicorn, and now I add valuation, and I'm less probable to actually make it to a decacorn. That is completely of course, this is a little bit statistically twisted. Most likely, you're actually really increasing your chances, but that's what the statistics would do.
Yeah.
And I think it's fascinating for the reason that most people really struggle to make do with resources and narrative and capturing market, building technology and product, and all of those hardships come before you. Usually they come before you ever make it to unicorn.
Yes.
And then once you're unicorn, you are well resourced. You have you should be well resourced. You should be having a well-run organization. You should be having a good product. You should be having great partnerships, great sales channels. So hold on. Why is it now an order of magnitude more difficult to compound on that compared to surviving all the way up to unicorn? It's nuts when you put it that way, because people would think with all those resources, it now becomes easier to compound. And yet the math shows you, no, it's actually harder to compound. That's the true fundamental question.
So I think that in my mind, there's two possible answers or hypotheses coming up, and I think they probably exist in conjunction with each other rather than being isolated. The first is how you emphasized on the word should, right? And I think maybe we can come back to that
Or
eventually,
execution.
right? So yes, they should have all of those things. The other, interestingly, and you and I had a separate discussion on this. Going back to that example of zooming out further and further and further away, I think as much as we hate to acknowledge it, I think the unicorn round has just become another, call it, uh, round in the long line of alphabets, where you just sort of move from a stage to another stage, right? For whoever cares.
Hmm.
And maybe when you get close, at or close to decacorn stage, either as a public, either as a private company or recently public company, that's when you have to actually properly answer the question of whether you get to hang, quote unquote, with
Hmm.
the top 1100 odd companies in the world. And I think that question just isn't asked, or the investors choose not to ask themselves those questions at a unicorn stage.
Hmm. Maybe, but then I still wonder, like, why don't they do it? And it doesn't take away the question of why don't you properly compound with all the resources in the world.
Mm-hmm.
I think that's the question worth asking.
Mm-hmm.
And based on that, the question worth asking then too is, why should I focus on these
Mm-hmm.
rather than finding the next 1060 to 1080 in
Yeah.
the 1130? That to me is the baffling. And I know to you, that has been to us the baffling part and where we have built our conviction here.
Mm-hmm.
So I'll skip the part of our thesis that we have here about what we think is the makeups and the qualities of decacorns. I'll skip all that because that's not what this is about.
Mm-hmm.
But let's make it about the 1060 versus the 50.
Mm-hmm.
Um, I want to make one thing clear. So we're not saying, oh, let's start a hedge fund and buy stocks
Mm-hmm.
in the existing 1060. Not our point. Our point is, why is it more desirable to build a company that belongs inside of the 50, although it is just barely making the cutoff to
Mm-hmm.
be in the off-spec range, versus building a company that looks and tastes and smells like the other 1060 if I have the choice between the two. That is adverse selection. If I actually limit myself to these 50 because my heuristics is Shub AI, but tech,
Yes.
that's actually adverse selection.
You're right. I mean, I don't think we've actually said it in any of our prior episodes, and I think it may not be true anymore, but it was true for 23 years straight. So I'll say it. I think you and I had brought this up to you in a private discussion maybe a year or so ago. So between 2000 and I think either 2023 or 2024, guess what the best performing stock on the S&P 500 was for 23 or 24 years?
I want to take an educated guess because I don't remember what you told me.
Mm-hmm.
My inclination is Apple, but it's probably not correct over that time frame.
Yeah, it's not Apple.
Which one is it?
Well, it's not Amazon, it's not Alphabet or any of it's believe it or not, Monster Beverage.
Now I remember. I was going to say Coca-Cola, but I knew that was not it. Okay.
So think about that, right? So here you have from the S&P 500, so the top 500 companies in the US, and if you take a random poll, everyone will say, hey, Alphabet or Amazon or Apple or Microsoft and companies of that sort. But it's a beverages company which crushed them. So isn't that mind blowing, right?
So brand and recipe and a lot of bottlers.
and look at demand and market compounding on itself. I would say. I think that is a necessary ingredient, maybe pun intended, necessary ingredient perhaps to look for a company which can belong in the remaining 1080.
So you set me up perfectly for a segue here, and the keyword is compounding.
Mm-hmm.
That is the difference between making it to unicorn and making it into the off-spec range of 10 to 15 billion market cap. Is, do you compound on something? And Shub, frankly, I do not care if you call yourself a venture, a company based on this or that technology,
Yeah.
or if you come to us and you say, hey, by the way, I'm selling building materials and here's how I'm doing it in a super scalable way, super capital efficiently. I'm building a house of brands.
Mm-hmm.
And here are all the things how I will compound.
Yeah.
I know that the latter actually works in certain markets, but
Yeah.
a traditional tech investor passed on this company because where's the software?
Where's the tech? Yeah, exactly. Yeah.
Right? We're, of course, speaking of infra market, but not only of infra market.
Yeah.
Okay, so here's my thesis
Mm-hmm.
of where I think the traditional venture perspective unnecessarily limits you when you are moving to the second question now that I had mentioned. So the second question being, why should any vertical produce these off-spec companies
Mm-hmm.
when there's only 50 off-spec ventures and they're all in software, data, infrastructure, and fintech?
Mm-hmm.
Well, let me first give you another number. So this one I had to look up.
Mm-hmm.
Okay, so the top 115 construction-related companies
Okay.
are roughly in that off-spec range.
Mm-hmm.
This is globally, from US, Europe, India, China, etc.
Sure.
How much total market cap? Sorry, how much total revenue do you think these 115? Oh, by the way, sorry, I just want to make sure. 115, how much percent out of 1130 is that?
Let's round it to 10%.
Interesting. How much global GDP goes into construction?
Also about 10%.
That's very surprising, right? Okay. So how much revenue do these 115 off-spec companies in construction make on a combined basis?
I think some of the largest ones, their revenue should be in the 100 billion plus range. The very top ones,
That is correct.
maybe the top 10 or so, I would say.
Yeah, especially the Chinese ones.
The Chinese ones, is Home Depot and Home Depot and Lowe's in the list?
They should be. Let me just double check. Not sure if I included distributors. So if you include distributors, it might be even more.
Yeah, I think
So I have wholesalers in the list, but not retail distributors.
I think if you include Home Depot and Lowe's, that'll again bump up the average in every aspect. But let's work with. Okay, let me do some back of the envelope. So
I don't have even paints companies, Sherwin. I also left that out. So that if you add that, it becomes even bigger.
yeah, okay. I think the top 113. If I had to take a mean of the revenue of the top 113 construction companies, I think the average mean revenue should be in the range of 2 to 5 billion. If I had to take a guess, it could be higher because of a few 100 billion plus company revenue wise in the top. So I'm guessing average revenue. Actually, you know what? Even Pool Corp is a higher revenue than 5 billion. So maybe I don't know what I'm saying.
Also not included. Pool Corp, I wouldn't count into construction. So that's home services. So I'm not adding home services.
It's also building materials though, but anyway, that's a different debate to have. Okay, so I'm going with a guess that the mean of the top 113 companies, the mean revenue is 5 billion.
Okay.
Was that? Actually, that can't be the case. That can't be the case because that would mean the aggregate revenue is just 565 billion. That I think doesn't seem large enough. Um,
I'm really loving this.
okay, so the overall economy of the world is about 100 trillion. I think it's a little bit more now, but let's
120. Yeah.
Okay, 120 trillion. In revenue terms, construction, again, depends on how you define it. If you're leaving out the likes of Home Depot, Lowe's, and some other guys, maybe it's underrepresented. Let's say we take a 5% representation, so that's 6 trillion, sorry, 6 trillion. But there, not all of it will be represented by the top. So, okay, so I'll guess an average of 10 billion per company.
Okay, so you're saying like what, 1.1 trillion?
Yes.
It's actually 3 trillion.
Oh, okay.
3.14 trillion out of the set of 115. And you're correct. I left out home services. I left out D2C retailers. Most of this is like, contractors, infrastructure companies, building materials companies, equipment OEMs, equipment rental companies, PPE OEMs, construction software companies. So Procore, Nemetschek, Autodesk.
That's pretty cool. So even within this list, that means the average revenue per company is about 28 billion.
So that is 115 off-spec companies that are absolutely undoubtedly attributable to construction. Okay. I did one additional subtraction here. Curious if this one I got completely wrong before I did the math, but curious if you know. So out of these 3.14 trillion, how much of that would be in China? Just take a guess.
Yeah, I would say 15%.
No, actually it's 30%, a little more even. It's
Wow.
1.2 trillion.
Okay.
Sorry, I asked wrong. I asked you how much of that is in China. That is not correct. How much of that is attributable to Chinese companies?
Yeah.
Yeah. So they could also do business in Africa, etc.
Yeah. Okay.
1.2. Yeah. So 1.9 is outside of China for these 115 off-spec companies.
Okay.
Pretty substantial, right? Yeah. So I think that's beginning to shape an answer of why I'm not interested to self-select myself to hunt a software company or a fintech company or a robotics company that tells me, hey, I can address a ton of different industries. If I can just catch the next of these 115, I'm going to build a much bigger company than any of these. Okay. Here's now, so that's the beginnings. Here's now my personal thesis of why I think the traditional venture perspective is actually wrong and why your and my perspective does make sense. So I painted it once on a sheet of paper here, not to walk you through it, but visualize this. So the world consists of different markets, and we can show them as verticals that can be consumer, retail, fashion, agriculture, this and that and the other. I mean, go through the industry NACE codes and you get an idea of what I'm saying. The world consists of various different markets, and they feed each other because some of them are upstream, some of them are more downstream, etc. And traditional venture investors, because they hunt the 50 to 70, but not the 1,060 to 1,080, they tend to prefer companies that can address millions of users across these markets. Because they have convinced themselves that it's more likely to become an off-spec company that is valued 10 to 15 billion plus if you can do that, rather than addressing in any single vertical. But what they omit to recognize is that, again, visualize the very different verticals now in front of your eye. Within each of those verticals and across the verticals that now your horizontal company is addressing, you're oftentimes only addressing a super thin slice of the spend in that. So fintech, let's take Stripe. Shub, give me a guess. I don't know the number. I'm guessing you don't know the number, but I think we can take an educated guess here. Of any of their customers' overall P&L, how much of that P&L is Stripe attacking with its revenue base.
So is your question how much of the business volume, revenue volume flows through Stripe, or is your question how much of Stripe's revenue is accounted for in the latter?
The latter.
1 to 2%.
If at all, right?
Yeah.
If at all. So I would think.
And by the way, not all of that would be Stripe's revenue. That would be the overall payment processing or the infrastructure costs. A lot of it is split with other providers as well.
So Visa, MasterCard, same question. What would you say?
Very similar. Again, 1 to 2%, also shared with the processing bank and so on and so forth, a POS provider, etc.
Okay. So that's fintech and data infrastructure. Sorry, let's fintech and financing infrastructure. Let's move to data infrastructure. Databricks, Snowflake. Let's include cybersecurity here, CrowdStrike, etc. Same question.
If I had to take a guess, so any one of these applications, I would again guess low single-digit percentage of revenue.
Because what is the overall software spend that people will have? It's like 5% maybe overall.
In theory, what you
10.
could argue, if you were taking a visionary approach, etc., is hey, as more and more information goes into the cloud, more and more there's more and more reliance on database structures, etc.
Yep.
You need to up your spend on cybersecurity. So theoretically, you can go from, I think, what is closer to a 1 to 2% today to maybe
2 to 3.
I don't know. Yeah, maybe higher. But you're still,
I would not dispute that.
Yeah.
I would agree with that.
But we're talking about low single digits in general as a percentage of revenue.
And of all of that software spend, I mean, a vast amount of that will go to SAP, Microsoft, etc. Okay, but still, we as venture, we love the CrowdStrikes, we love the Databricks because they're terrific companies.
Yes.
But what they are doing is they address a million different verticals with a extremely thin slice of the spend. But we've convinced ourselves that's the only way how you can build an off-spec company, which is ridiculous because literally that is the only recipe to build the 5% off-spec companies, but not the 1,060, the 95% off-spec companies. Interesting, right? By the way, I want to do the same for marketplaces. So Uber and Airbnb, how much of the spend?
I think in Uber's case, if I'm not mistaken, their take rate, which is what they recognize as revenue, maybe around 20%-ish, give or take. And I think they might be similar for your DoorDashes of the world, your Instacarts, Zomatos, Grabs, etc., etc. Similar sort of model.
Yeah. Yeah, and then within the consumer wallet, probably Airbnb, just in the consumer vertical, would probably not be 1 to 2%. That will be for those customers. They will probably attack 5% of the overall spend. You know, if you take the holiday part, for business travel, there will be a separate account, but that will then actually be much, much, much less. Again, that you can attack. Interesting. Okay, but let's do the same exercise for the off-spec companies that are traditional, and let's now move into our space. A cement company that is a cement manufacturer. How much of the spend of its vertical is that attacking?
So if you combine, for example, you're talking only cement, or you're lumping in cement, concrete, other structural materials, etc.?
You're doing the exercise for me, but okay, we can take that shortcut and we can say, hey, actually, you are not a single product company. You're a multi-product company with different channels. Let's take the multi-product company and take that shortcut.
So if and I don't know if that's where you're going, if let's say we oversimplify to say structural materials and finishing materials, and let's say a cement company can take on the structural material spend. As a heuristic, I would like to say, I mean, on volume terms, it would be far greater, but on value terms, that would be what, maybe 50% of the material spend, which, does that sound right?
Yeah, maybe a little bit less, but
okay. And depending on the state of the economy, which economy it is in, that may be anywhere from 25 to maybe 40% of the overall budget or value of the structure being built.
Yeah, if I'm now a roofing materials supplier, vertically integrated, and I'm using the word vertically integrated because I'm going to come back to that. Vertically integrated, I'm maybe attacking 3%, 5%, 7%, 10%, depending on how far I go of the overall spend. Sorry, not by vertically integrated, including labor and installation, etc. And depending on the project, it will vary, etc. But you are seeing the point here, right? It is that you are actually addressing a substantially larger pool. And why is that the case? Because in construction, 1, 2, 3% of the overall industry is spent on software and payments, etc. Then you add a little bit of insurance, so make it maybe generously 2 to 4%. That's it. 45% is going to be material. Another 45, 50% is going to be labor and services.
Yeah.
Right? So in these off-spec companies, these 115, so let's work with real numbers here, right? So let's use a few ones that we know. So Bouygues Vinci, 2 super large French general contractors, 60 to 70 billion. It should be said, not all of that is construction revenue. So both of them are a little bit diversified. ACS, a large Spanish infrastructure and high-rise builder, infrastructure builder, 36.7 billion. Then we have a few Japanese ones here. We go to maybe building materials, construction equipment, Caterpillar, 67 billion. Here's an engineering design services company, 4.4 billion. Arcadis. I want to have my building materials companies. Where are they? Here. CRH and Holcim, 30 and 35 billion, right? That's a lot of revenue, and market cap is around 62 to 64. And yet we're convinced, are we really supposed to convince ourselves it's more desirable to build the 10 billion thin slice company than the 65 billion building materials company, to rebuild that? I find that an odd proposition, I have to say.
Yeah, I mean, look, we're discussing very large, very well-known names. It isn't lost to me that, we spoke about Pool Corp like a year or so ago.
Yeah.
It isn't lost to me that a company as obscure or quote-unquote obscure as that was worth 15 billion, right? just to put it out there. So that also belongs in this elite list of ours.
Indeed.
Yeah.
Kingspan, 16 billion. Saint-Gobain, 60 billion. Interesting. Knauf, 17 billion revenue. So people at this point might listen to us and think, yeah, these guys have smoked something. I mean, if you like the company so much, just buy their shares. That's not the point. The point is we do see opportunities to build modern versions of these vertically integrated, dominant industry players. And the proof is literally out there that you can build much more off-spec companies if you don't limit yourself to a thin layer of addressable market across many industries, but you actually dedicate yourself to dominating just in that one market. And venture has produced these examples too. Shub, what about SpaceX? I would call that a vertically integrated hard company.
Absolutely.
Completely vertically integrated.
I fully agree.
I think the folks at Founders Fund would say that. What about Tesla?
Also, I think fits that description.
One vertical, right?
Yeah.
What about the Chinese automotive OEMs like BYD?
I think BYD would also fit that description.
How old are these companies?
I think BYD, I want to say, is around 20 years old. Let me check.
Yeah, let it be that much. I mean,
22 years old.
22 years old. Yeah, and then there are younger ones, and Xiaomi, when they launched their car, that must have been like 5 years ago.
Yeah.
Right?
Xiaomi was, I think, early 2010s, I want to say. Let me check.
Yeah, but that was without the automotive division. And then when they launched the automotive division, that was more like 5 years ago, I think.
So Xiaomi, the whole company as a whole, was founded in 2010. Yeah.
When I started my career in corporate finance, M&A, solar wind, one of my first clients on the buy side was a Chinese solar manufacturer called Suntech. At the time, it was a 4-year-old company with 10,000 employees. 4-year-old company. It was literally a startup. You called it that way. It was a startup. 4 years old, 10,000 employees, and the largest manufacturer of solar modules back then. The company then had a rough ending years later, but it was a startup. It wasn't a startup that you would, expect to see in the enterprise software space addressing many, 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 many thin slices across horizontals. No, it did the one thing with vertical integration and attacking that one market really well. And Musk is doing that as well. Musk isn't rebuilding PayPal.
Yeah, that's right.
Interesting, right?
Yeah.
Anduril, 30 billion in the recent valuation. How many verticals is Anduril?
Just one? I mean, at least to the best of my knowledge.
Yeah, I mean, maybe they have a secondary product somewhere, but I would say it's just defense.
I mean, look, to be fair, someone may say, hey, it's not just defense, it may have aerospace, but okay, fine. To that extent, maybe it's two.
If you look at their revenue base, I would be surprised if that would be meaningful. I don't think that's the reason why someone gave them a 30 billion valuation recently. I don't think so.
I would agree. Yeah.
And Anduril can be called vertically integrated. Everything.
Yeah.
Everything. So Shub, you and I want to round it off now because I think people are getting the message. Why should it be the only desirable way to chase young, high-growth companies that have a compounding and scaling advantage that lasts beyond unicorn? That are only this 50 to 70, the way that venture is known to build them, rather than how the world is known to build them in the other 95%, the 1060 to 1080. That to me sounds like adverse selection if that's what you're doing. And I'm much rather with 10,000 repetitions in my vertical that is proven to produce these companies and catch the next ones that will do that with technology and repeat that and challenge them than chasing these 50 to 70 that have to address thin slices of revenue across many different markets. How about you?
I feel the same way, good sir.
Very good.
Yeah.
Cool. Any closing remarks on this from you?
I mean, one theory I have, but I don't want to get us into a rabbit hole right at the end. I think the venture mindset goes through its weird loops of learning new things and forgetting old things and not forgetting old, new things fast enough. I think the lessons of the current generation is based on what the quote unquote good lessons VC believes it has learned from investing in stuff like shared economy companies, cloud companies, etc.
Yeah.
And it has forgotten that once upon a time VC also had invested in Apple, in Nvidia, etc. Right? By the way, when I say this is
incredible bathtubs, by the way.
Yeah. So they invested in that decades ago, back in the 80s and whatnot. So perhaps it's time to, they say history as a way of rhyming. Maybe it's a way to go back into Venture's roots and learn from Venture's history. Maybe we are holding on to some transitory lessons for too long.
So, and I would contest you should go even further back and think about when were these 1050 plus actually created and what was that playbook and how can I now actually participate in that next generation of it in an accelerated fashion. That's the adverse selection I want to eliminate.
I wholeheartedly agree with that.
Cool.
Well. Yeah.
Good. I think at some point you and I will also reveal what we think those companies can look like in the future, what we're looking for, etc. But there's a bit of a risk of reverse engineering, telling us what we want to hear, etc. So we'll hold off on that maybe a little bit longer. But I do think, to your credit, we have the first one already in our portfolio, and that is Inframarket. Fits exactly that description.
I think we have potentially a few more. I mean, fingers crossed. Compounding takes time, and it's a probabilities game as well, as we have just discussed. But I'm very excited for what's to come.
Yeah. But yeah, very good discussion, sir. Thank you.
Totally. I'm glad you firstly did all the research and also triggered this topic. I think it's actually a very profound one.
Yeah, back from the old days.
Indeed.
Thank you, sir.